Yeah, hi there. Well, there's a lot going on. September has definitely started with lots of cross currents. Markets are back over 3,000, so basically all the volatility that we saw in August is now resolved. So you had a lot of market volatility going nowhere in August, and now we're going back to the previous high that we had back in July, and that's about S&P 500, 3,000. So um, it's interesting what kind of set off this rally in September, and I think what happened. You have to go back to the bond market. So it was interesting on like September 4th. That was the low in the 10-year Treasury. 10-year Treasury bonds hit like 146 that day, which is of course incredibly low, and basically gave a pretty extreme inversion to the yield curve. I think at that point, sort of technicals kicked in. There was no news really, and I think bonds became very overbought, and there was this rotation out of bonds. And so you saw basically within 10 days, you saw the 10-year Treasury go from 140, 1.4% to 1.9%. So that's quite a move in interest rates on the long end of the curve. So did that foreshadow better macro data or better economic activity? At that point, we didn't know yet, but certainly one of the things that set that off was the indication from the Chinese side that they are talking, or they had the intention to talk with the Trump administration. So part of that is trade negotiations are back on track, which certainly spooked the longer end of the curve. But it also kind of set off a rotation in the market from growth stocks that have been carrying the market pretty much for the last 3 years into more cyclical or value-oriented stocks. And certainly one of the big components within the value space are financials or banks. So you saw once the long end of the curve in the bond market started showing higher rates, and certainly there was an anticipation that the Fed would lower rates, which we just got another 25 basis points. So a realignment of the yield curve was something that certainly benefits banks. So you saw a nice rally in bank stocks, which certainly helps value managers, but you also saw some relief rally in incredibly oversold industrials and manufacturing companies, things have been pretty dismal there in terms of stock activity, price action. Basically, what the market had done to many of the petrochemicals or typical industrial type names is pricing in a recessionary earnings per share, and we'll see if that happens. So we got a lot of macro data in the last couple weeks, which kind of confirmed this kind of rotation into more cyclical exposure. Retail sales we got about a couple weeks ago now. That was very solid. Certainly the U.S. economy, if the consumer stops spending or for some reason there is a dislocation amongst the U.S. consumer, that would be terrible for the outlook for the U.S. economy. That came in very solid. Then this week we got industrial production. That surprised on the upside, also very strong. And the last piece we got out of macro data was housing starts. Housing starts also surprised on the upside, which was certainly a good precursor to any other type of economic activity. Obviously, housing, you get a lot of multiplier effects with housing starts, especially new homes. People buy new washing machines and new furniture and all that, which bodes well for economic activity. One of the data points we also saw relating to housing was we saw a massive spike in refi activity. So, the consumer is taking advantage of lower rates, which they should. I mean, if you haven't refinance your mortgage with these low rates, you're crazy. So refi activity has gone up a lot in August, and that typically bodes well for the leading economic indicator. I mean, the leading economic indicator for the U.S. economy has been sloping down. Typically, when refis spike, you get a lift in the leading economic indicator, and that bodes well for GDP growth going forward. So that's it on macro. The other news, obviously on Sunday, we had the attack in Saudi Arabia. Talking to my friends who cover oil and gas, this was an extraordinary event. I don't think we've ever seen a strike that would take out 50% of oil production in Saudi Arabia without really any massive dislocations in the capital markets or stock market. So you saw, as a result, oil spiked up 17%. So that kind of quickly kind of declined again once the Saudis made it very clear that they can fix their production within the next couple of weeks. That seems a bit wishful thinking, but it's extraordinary to think how much money the Saudis are putting into repairing the damage. And if you think about, basically the drones hit two fields. One was a more refining, a facility which is one of the big refining facilities for oil, and the other one was an actual production site. So it is amazing to me that basically 10 drones can take out half of the Saudi supply in one full sweep, and it seems like it doesn't matter. So what the strike has ironically done is it's basically taken away the oversupply of oil that we had in the system. That was one of the reasons energy stocks have been so depressed, and that is the reason for that is we here in the United States, producers in the shale, so this is the shale producers in the Permian Basin and in the Bakken, in Texas and up north, they've been producing oil like crazy. So the United States is the biggest producer of oil. So obviously this strike really benefits domestic U.S. producers, especially in the Permian Basin. So you've seen a lot of cyclical kind of stocks moving up that are related to the oil and gas side, especially relating to the Permian Basin. So we will continue to watch the geopolitical side. It's interesting now in New York City, we have the General Assembly going on at the UN. That is typically an opportunity for leaders to meet officially or unofficially. We heard that basically the two leaders, or the Rouhani from Iran and his foreign minister, will be coming to New York to speak at the UN. There was some indication before the event in Saudi Arabia that Trump would be meeting with Rouhani. That was the expectation. But it's unclear what will happen there. So we watch that closely. Obviously, a military event with Iran between the U.S. and Iran would not be something that would be market positive, but it seems that is not necessarily something that's on the table right now. Other news. The General Motors strike started this week, so we haven't seen a general strike in many decades. So this is new. It's a bit surprising given we have a president who is a protectionist and is trying to bring production, especially auto production, back to the United States. So the trade unions have decided to go on strike given there was no deal. That affects production and economic activity in the U.S., so we're watching how much that would affect GDP growth. Certainly, if that goes on for many more weeks, it will have an impact on already weakening GDP, so that's something we're watching. The other political event that we're watching is on the healthcare side. There seems to be a discussion between Pelosi and Trump on drug pricing. Those talks actually fell apart today, but I wouldn't be surprised that the Trump administration and Pelosi can get somewhere on the same page on drug pricing. Obviously, drug pricing has been the sort of the cloud weighing over healthcare stocks, especially biotech stocks, which we like a lot. So any resolution on that front or actual a clear policy about pricing going forward would obviously be beneficial to the group going forward. So there are a lot of cross currents in the market right now, but I think given the macro data that we saw, I think the conclusion near term is there's an all clear for stocks going higher at this point. Technically, things look good. The yield curve is starting to act more normal. We got the lower interest rates from the Fed. So liquidity is driving stocks and economic activity at this point. So we think it's all clear going forward. That's it for now. Take care.